The paper gold market is flashing a default signal as the COMEX spot price whipsaws, while physical gold is vanishing from dealer vaults. If you watched my last update, the paper trap, you know we're in an historic decoupling. But today, the question has shifted from why is this happening to when do I get back in? Specifically for the gold miners and silver miners, is the worst of this liquidation over, or are we catching a falling knife? Today we break down the gold price prediction of 2026 through the lens of the Trump-Iran news, and why the next 96 hours are the most critical window for your portfolio this year. Welcome to Money and Power. I'm Richard, and today is Tuesday, the 24th of March 2026. And for the record, the market data I am referencing is as of 11:30 a.m. GMT. Similar to the analysis on Kitco News and the Economic Ninja, we provide the orientation the 98% are missing. Now, before we dive into the buy signals, please hit the like button and subscribe. It helps this voice of reason reach more investors during this global repricing. Let's look at the volatility of the last 24 hours. In our previous video, we analyzed the crash towards $4,200. To be precise, we saw gold plunge to a 2026 low of nearly $4,100 on sheer liquidation and margin call fear. But the moment President Trump announced the 5-day postponement of strikes on Iran, the market didn't stay down. It snapped back. Now, as I record this, gold has recovered to just over $4,440. This V-shaped recovery tells us two things. First, the paper shorts are terrified of being caught off guard. And second, the market is currently trading entirely on geopolitical headlines, ignoring the underlying reality of $38 trillion in US debt. But don't be fooled by the bounce. While the paper price whipsaws on every tweet, the physical storage is intensifying. In London and Zurich, premiums on physical silver and gold kilo bars suggest the COMEX spot price has become a work of fiction. Silver is struggling to stay in the paper 60s and early 70s, while physical coins are being sold in the 80s, 90s and beyond. Now let's address the elephant in the room. The gold miners. Many of you are asking, is the worst over? Should I buy Newmont and Barrick now or wait for the 5-day Iran window to close? Here's the 2% perspective. If you wait for total confirmation that the Iran dispute is over, you will be too late. The market is a discounting mechanism. If a permanent de-escalation is announced on day 5, the GDX and GDXJ will likely gap up 10 or 15% before you can hit the buy button. However, we must look at the energy floor. As of 11:30 a.m., Brent Crude is at $101 and WTI is at $90. While this is a pullback from the recent highs, it remains a silent killer for mining margins. For the miners to truly bottom, they need to see energy costs stabilize. So what's the guideline? Well, the worst is likely over for the metal itself, but the miners are still fighting a surging dollar index, currently at 99.27. This DXY strength is raising the cost of global debt for these mining majors. I am personally looking at a staggered entry, positioning perhaps 50% now to catch a potential V-shaped recovery, and holding 50% in cash in case the end of the 5-day window brings one final liquidity flush. Navigating this requires more than a daily video. It requires a structural framework. Now join the 2% brief for deeper weekly analysis on the global monetary system, gold and silver. In the 2% brief, we look at the credit markets and the sovereign wealth shifts that move the smart money. Join us at the link below in the description or in the pinned comment. Silver and the China factor. We cannot ignore silver. While gold is the fear trade, silver is the systemic trade. We are seeing China's silver export restrictions create a vacuum in the industrial market. If you are watching silver at its current $70 level, rising to $80, understand that this isn't a spike, it's a structural adjustment. The silver supply cannot respond to a $10 move. It takes years to bring a mine online. With AI infrastructure and solar demand at all-time highs, the paper crash in silver is an absolute gift for those who understand the gold-to-silver ratio. When the paper shorts finally cover, silver won't just rise, it will melt up. Now, what's my gold prediction for 2026? It remains broadly unchanged, and due, let's be blunt, to the unpredictability of the current US president, the price can vary significantly. We have a target, I would argue a low target, of $5,000 and a high target of $6,000 this year. This current volatility is the shakeout before the breakout. The 98% are staring at the $4,100 to $4,400 swings and feel sick. The 2% are watching the US debt clock and the physical vaults and feeling opportunistic. The next 5 days of the Trump-Iran postponement are a gift of time. Use it to position, not to panic. If you are in the miners, watch that $101 Brent oil level. If you're in the physical, ignore the spot price and watch the premiums. Looking ahead over the next few weeks, there are 3 specific developments we are monitoring for the 2% brief that will define the next leg of this monetary reset. First, we will be diving into the basement liquidity of the LBMA to see if the London vaults are truly as empty as the premiums suggest. Second, we're preparing a deep dive into the BRICS Plus bridge and how the new gold-backed digital settlement systems are preparing to bypass the SWIFT network entirely. And third, we will be looking at the silver to solar pipeline, analysing why the industrial demand from the massive renewable energy transition is creating a supply cliff that no paper contract can fix. These are the structural shifts that the 98% will only hear about when it's too late. If you want to be positioned before the headlines hit, make sure you have notifications turned on and you are subscribed to both this channel and to the 2% brief on Substack. The system is repricing in real time. Don't be left behind. Thank you for watching, and I've put 2 videos on the screen, both of which are relevant to today's video. Click one now to keep your orientation, and I will see you again soon.